Hello, welcome to our presentation. Here we are from Group 6, presenting our strategic management case study report. Our company is Tiffany & Co., which is also well-known a jeweler and also established company in the world. Then our members include Semakula Ramzi, Anas Lawali, Muhammad Aisha, Mustafa Ali, Basam Muhammad, and also Kamal Din Ibn Chambas. So when you look into our overview of the presentation, we have like internal assessments, external assessments, also our proposed vision and statement for the company, introduction about the companies, and other different analysis and recommendations based on the findings of which I've got. Thank you.
My name is Kamal Din Abdullah Ibn Chambas, and I'm going to focus on the introduction part of our work. So basically, Tiffany & Co. company is a global recognized luxury jeweler founded in 1837. We look at the specialty retailer headquartered in the New York City. Basically, we have about 296 stores worldwide. Okay, so presence in the American, the Asia, Pacific, Japan, Europe, and emerging markets such as the United Arab Emirates and Russia as well. We look at the jewelry, timepieces, sterling, silverware, china, and crystal, stationery, fragrance, and also accessories. Now, we look at the vision and the mission. So basically, when we look at the vision and mission to be actually the world premier luxury jeweler, creating timeless and exquisite designs that inspire and delight our customers. We also look at that we are actually committed to excellence in craftsmanship, innovation, and in design, and also apparel, customer service. We look at the mission also. When we look at the mission, we look at the fact that we actually celebrate life's most meaningful moments with elegance and style, whilst also looking at the upholding our legacy of equality, sustainability, and also social responsibility. We look at the reasons. The reason is that to actually ensure global expansion by expanding our business globally, to be able to get more people, also have to do with the second one, which has to do with brand protection and also enhancement, to be able to protect our brand, to be able to attract more customers, and also at the end of the day progress our company. I thank you so much for your audience.
Assalamu alaikum. Hello, my name is Anas Lawali. I'm going to present on internal assessment. So we have strength and weakness. So the strengths are the Tiffany brand signify higher quality gemstone jewelry, intensive selection and brand and broad price range of branded jewelry. So sale increased 3% in 2013. Constructural agreement to purchase diamond mines. Tiffany owned diamond processing operation. Also excellent customer service, and also increase in the average price for jewelry sold. Proprietary trademark registration, and also elegant and upscale store environment and location, and also distinctive package in the Tiffany blue box. Next slide. So the weaknesses are Tiffany retail price of diamond jewelry is far the highest in the industry, and also competition for engagement jewelry sale intense. Also no co and no divisional precedent by the region or type of product. And also Tiffany sale are seasonal and dependent on economic conditions. Also party may terminate the agreement at any time. Also higher advertising and packaging costs, and also entail higher retail space costs. Also policy not to engage in price promotional activities. Also lower gross margins, and also limited display space for new product introduction. That's all from me. Thank you.
Assalamu alaikum. My name is Aisha Mohammed, and I'm here to present external assessments. So looking at the opportunities, we have 1.5 increase in US household earnings. We also have online sales that have continued to rise over the past decades. We have the use of analytics. We have willingness to pay premium prices for prestige products. We have selling jewelry at growth, selling selling jewelry to grow at a 2.4% annual rate in revenues. We have falling unemployment rates. The diamond jewelry segment accounts for approximately 45.0% of industry sales. We also have demand in the United States. United States is expected to continue to increase. We have increase in customer preferences for platinum ring, platinum jewelry that has slightly increased over the past 5 years. Moving to the trends, we have the cost of gold has increased an average 4.5% per year. There is security breaches of well-known retailers. We have competition from the internet wholesalers and retailers. We also have decline due to product high maintenance. We have privacy breach in Tiffany's information system. Watches segment has slightly declined over the past 5 years. Diamond jewelry segment has shown a small increase. Declining number of marriages over the past 5 years. Most people buy jewelry when they have disposable income. Unable to pass on increased costs to customer due to decreasing demand. Thank you.
Okay, Assalamualaikum. I will be presenting about the SWOT matrix. So the strength opportunities, the first one is leverage. Tiffany's strong brand to expand aggressively in emerging markets. And then utilize Tiffany's manufacturing capabilities to develop new product lines targeting younger consumers. And the third one, we expand e-commerce operations globally. And then the strength threats. The first one is diversify product offerings to reduce dependence on diamond jewelry and capture more market segments. Then increase market efforts in non-US markets to reduce reliance on the American market. And then the third one is invest in supply chain management to mitigate the impact of fluctuating material prices. So if we move to the weakness opportunities, the first one, we shall emphasize Tiffany's heritage and craftsmanship to differentiate between competitors and justify premium pricing. Then leverage Tiffany's vertical integration to maintain quality control and mitigate supply chain disruptions. And then utilize Tiffany's strong brand to expand into new product categories less affected by economic downturns. And if we move to the weakness threats, the first one, we shall implement more flexible pricing strategies to adapt to economic fluctuations and currency exchange rates. Increase focus on fashion jewelry to offset potential declines in engagement ring sales due to changing marriage trends. And the last one is invest in advanced security measures to protect against cybersecurity threats and data breaches. Thank you very much. We shall move to the next presenter.
Assalamu alaikum, my name is Mustafa and I'm going to present about BCG matrix. BCG matrix stands for Boston Consultation Group. So we have some points, 3 ones. The first one is stars. This includes Asian Pacific. This is invest heavily to capitalize on growth opportunities and maintain market leadership. The second one is cash cows. This includes Americas, Japan and others. Use the stable and substantial cash flow from this division to support investments in the stars and other strategic initiatives. The next one, last but not the least, is no question marks orders. Currently, this company, Tiffany and CO, does not have division in the question marks orders quadrants, suggesting a relatively stable and strong portfolio. So this is the brief about BCG matrix. Thank you.
Assalamu alaikum. My name is Mohammed Bassam, and my part for our project is recommendation. So we have expand to Asia Pacific. So Tiffany company should strategically expand into the Asia Pacific region to tap in growing markets at assumption cost of 374 million in USD. So we also have second point, diversification of product line. Every product needs diversification, coming out with new brand, new product in order to attract customers as compared to your competitors. So we also have the third point, increased marketing effort in non-US, such as Germany, we have Canada, we have Australia, we have South Africa, and many more. So let's also look at the fourth point, the fourth point, that's a implementing more flexible price strategy. Everybody knows that people buy things based on their demand, right? So if Tiffany is able to strategize their pricing, would enable them to get more customers as compared to their customers, their competitors. Sorry. So we have increased focus on fashion jewelries. Most jewelries are just meant for fashion. So Tiffany should kind of come out with what fashionable jewelries in order to attract customers, more customers than their competitors. So we also have invest in advanced security measures. And the second to last point, we have utilize Tiffany's strong brand to expand its new projects. For example, if they are able to invest for about 600 million USD, would enable them to utilize a strong brand in order to expand their investment in other countries. So let's look at the last point. We have invest in supply chain management. So supply chain management, as we all know, that it been moving from one country to another. So they should stabilize their supply chain in order to get into other countries to attract customers and demand. Thank you.
Hello, my name is Zuberi. I'm coming to present about earnings per share to earnings before interest and tax analysis. First, when we look, we have two ways of financing. We have common stock financing and the debt financing. And here are our initials. Then we have like the pessimistic, realistic, and the optimistic. When you look into common stock financing, we have $200, $300, and $400. And also the same on the debt financing, we also have $200, $300, and $400. So based on the information, based on the analysis here at the end, our earnings per share from the common stock financing is $18.17 $27.5, and then $36. And then also we have on debt financing, we have like $33, $52, and $71. So our financing decision here, we have come to conclude that we need debt financing because it has more earnings per share than common stock financing, because if we use common stock financing, we shall be needing to issue more stocks, which in the future we may not be able to cover back. But debt financing, since we can earn more from the earnings per share, so we use the debt financing. Thank you. Hello, I'm here again to present our projected financial statements. First, when we look into our projected income statement, we look at our revenues. Revenues here from the shares which were projected in the next 3 years, and based on our recommendations. And also the cost of goods sold is also there, our gross profit. And the most important thing is when you look into our change in the net income. So compared to our historical data, we have here a higher net income because our recommendations are based on strategies like expansion. Expansion involves like it gives the company more access to more customers and other things. So this one will increase the customers in your net income. And also we have like our things like earnings before interest and tax also were reduced because of our financing strategies which I've chosen. Then when we look into our balance sheet, we have balance sheet. Well, most of the important things like cash and equivalents here. We also have the information here for the next 3 days for our recommendations. Also, when you look into our total assets, here they also total assets compared to our historical data has also increased because our recommendations are based on expansion and reach to our customers. And also liabilities here, we have reduced our liabilities because most of the recommendations are more based on the products within the company, not outside the company. So, and also our equity here, the common stock, we have increased like to 2, 3, and 4 based for the next 3 years. And also our total liability and equity, which has slightly increased compared to our previous historical data. So in conclusion, when you look into the plans of the company, first, the company has put more effort into strengthening its security and other such kind of measures like expansion in other markets such as UAE and other things. But in our plans, we have put we are also focused. We have a plan also to expand to Asian countries such as to other markets like UAE, Russia, and also we high status of including such other fast developed economies such as Singapore and Malaysia. And also we in our recommendation also we recommend the company also to like leverage its strong brand name to also like establish its superiority in the market, because the company is more focusing on the products, not on the customers. So its brand is losing value. So when we compare our financial information, our financial ratios here like earnings on equity have gone to negative because of our financing decision. Our financing decision is debt financing because in the next 3 years from here, we're also going to use the returns from the operating profits in order to finance this information. Thank you.